Hey, cash flow maximizers. Welcome to part 2 of our Indexed Universal Life series. If you missed part 1, I'm going to put the link right up here. Be sure to check out part 1 where we go over the good, the bad, and the ugly in our pros and cons on IULs. In this video, we're going to go over 3 different policy designs with a top IUL carrier. Our first design will be what you would typically get from just any agent off the street who is interested in selling you a policy and they have no idea what they're doing. The second one will be a slightly better design. It will have some of the key characteristics that we're looking for, but it's still going to be the way that you might get it designed by somebody who doesn't actually know how to maximize it. So what they're doing is they're going off of the software that the company gives them, and it says, this is how you can maximize, but it doesn't really maximize it. So I'll show you that and the numbers associated with it. And then our third policy will be a maximized policy with optimum benefit for you, the client, and minimal charges for insurance. I'm going to get in depth on those. I'm going to show you exactly what the charges are that come out of those. One of the advantages of an Index Universal Life illustration is they can show you what all of the charges are. You won't get that from any whole life illustrations because the companies are not required to provide that. But an Index Universal Life illustration can show you the expenses. The companies are required to provide that to their agents, but the agents are not required to print that as part of their illustration. So something that you should be aware of is Index Universal Life illustrations. Agents do have the ability to print up the charges associated with that policy, and you can see them for each year. And we're going to go over that in today's video. So stay tuned, and we're going to jump right into it.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Okay, so what we have here is we have a 35-year-old male with the highest health rating. Okay. Let me get my pen out so I can illustrate this. 35-year-old male, we've got the highest health rating. So they're going to be getting the best rates. I've done this for each of the policies because I want you to be able to see what's possible. Okay, so this is a 35-year-old male with the best health rating and state of Oregon. Okay. Now we've got death benefit and funding. This is your standard level death benefit life insurance policy. We can see here, I set it up to do a minimum death benefit, max cash value as provided by the insurance company's software. Okay, so I don't put in the face amount. I put in that I want a level death benefit. Down here, we have nothing extra added into the first year. But what I did want to specify is that we want to do $6,000 a year. Okay, all of these 3 policies are going to be $6,000 a year premium policies. As you can see, I didn't put anything else in here. We're not doing a 1035 exchange. I didn't put anything in here about pulling money out, no loans, nothing. This is just your basic policy that anybody can design, okay? Let's look at the riders on the policy. Nothing special here. Death benefit protection, of course. Coming down here, these are automatic with this company. This is one of the reasons this is one of the top IUL companies, is you get terminal illness rider, chronic illness rider, critical illness rider, and critical injury rider. These are riders that allow you to access the death benefit before you actually pass away. So it can help you to offset major expenses that come across when it gets close to end of life without having to dip into family savings or things that your family needs to live on at the time. Okay, quick look at our interest rates. The max that we can illustrate here, well, I can illustrate higher, but what I do is S&P 500 point-to-point cap focus. We just put 100% in there. The assumed rate on that is 6%, 6.03%. That's pretty typical. When we get into looking at historical averages for the S&P 500 with a cap, that's where they end up coming out. Overall, I think it's a pretty accurate rate. The problem with a lot of IULs in the recent years past is people were illustrating them at 8 and 10 and 12% because the software would allow you to do that. And that's just not realistic. I've always bumped mine down to 6% just because I think it's a more realistic amount. I would rather people go into this expecting to get a lower amount and then being happy that you ended up with a higher amount. Which you'll see. So in my next video, in part 3 of this series, I'm going to go over my IULs. I just signed up for one last year. Actually, I did a few different ones because I also did my daughter's. But I just signed up for those last year so that you guys can follow along with me on how this policy performs. Well, we just passed the first year mark and I got credited 11.5%, which was where my cap was at because the market rate went up higher. The S&P 500 went up higher than 11.5%. So when it comes to looking at the average of these, I think 6% will end up being a fairly accurate amount for illustration purposes to consider. Next, let's see how these things perform. So first, I'm going to go through each of these policies, and we're going to look at how each of them perform, and then I'm going to go over the expenses of these things, okay? So we've got our quick view on our software where it just spits out and it tells us what's the accumulated value on this policy, how's the death benefit look. So in this case, we got an initial face amount of the policy, $541,000. Our annual premium is $6,000. Our MEC is $16,000 because I set the premium. This is the base premium. I set that amount as what the client is expected to pay each year. Okay. And so when I set that $6,000 as the base premium, as you all know, we can do a lot more than that if we want to MEC, if we want to add in more. Okay. But if I'm just your average Joe agent and I want to design this policy, if you tell me you got $6,000 to put in to buy life insurance, I might just put in $6,000 as what you're going to pay and let the software spit it out. This happens to give me the highest commission as that average Joe agent. So let's see how this performs. We've got our surrender value is the amount of cash value you have in the policy. Okay. So in the first 2 years, we've got $0 available. That's just how your basic policies perform. Unless you have a broker who is trying to maximize the cash value available to you for your use, like we do in infinite banking, your basic policy is not going to have any cash value in the first couple of years, as illustrated here. So let's shoot way down and look at, we're going to go to year 30. Okay. 30 years is a pretty good time scale to view policy growth over time. Okay, we're looking at year 30. This client will be at the end of year 30, they're going to be 64. The end of that year. $6,000 put into the account. $395,000 is our accumulated cash value. That's also our surrender value. And our death benefit stayed the same, $541,636. Now, that's not bad. There's some agents out there that can sell people on that type of growth and how that's a good thing, okay? If you put $6,000 a year for 30 years, you're $180,000 into the policy. $395,000 puts you at just over double what you put into the policy, okay? For a lot of people, that's good enough. And they can get sold on this and they will gladly sign up. And they may be happy. They may be happy with that, okay? The only downside is they're expected to put out $6,000 a year. They don't have a lot of flexibility to go a lot lower than that. And be sure that the policy is going to sustain itself as the insurance costs get more and more each year. So let's remember those numbers. $395, $243 in cash value, $541,636 in death benefit in year 30. Now let's move to a policy that has a little bit different design. This policy is still marked minimum death benefit, max cash value, as determined by the insurance company's illustration software. Not going to put in a face amount. We're only going to change the level death benefit to increasing death benefit. We are going to go down here and specify that we want to put $6,000 a year into the policy. Okay. As you can see, everything else is the same. Nothing else is filled out. Quick look. We still have the same client information, 35-year-old male, elite non-tobacco health rating, and they're in Oregon. Our riders, all the same. Interest rate, 6.03%. That looks the same. Let's see how our cash value grows. Okay, so a little bit better. We got $6,000 we put in the first year. We're at $1,000 cash value. All right, not bad. That's better than zero, right? So an inexperienced agent might show you this compared to the other one and say, look at how much I'm doing for you. Look how well I can design this policy. What do you think about signing up? What would you rather do, that one or this one? Because this is the best that they can do. Year 2, instead of zero, now you're at $6,604. All right, not too shabby. Let's go down to year 30. So just like our last one, we've got year 30, $6,000 a year going into it. Now, $439,720. That's pretty good. We went from $395,000 to $439,000. And our death benefit even went up. We're now $663,565. Not too shabby. So your average Joe agent may show you this illustration and pat themselves on the back and convince themselves that they are offering you a really good opportunity here. Again, it's not terrible. I mean, this isn't horrible, okay? But we can do better. So let's take a look. Oh, one thing I didn't point out was that the death benefit starts out, instead of $500,000 death benefit, you started out with a $228,000 death benefit. So one thing you'll notice is when we reduce the insurance charges, when we reduce the amount of insurance that we're buying, it increases the amount of cash value that you get in the policy year after year. So that's why we end up with the higher cash value, surrender value in those first 2 years. It's because we greatly reduced the cost of that insurance, okay? And then all of those savings add up over those 30 years. So it's not magic that turns these numbers around and increases them. we're decreasing the cost of our insurance so that we can increase our cash value. It's the same thing we do when we design our whole life policies to function for infinite banking. Now let's look at an optimized policy. Our optimized policy I don't want to get ahead of it. Let's make sure everything is the same, okay? We've got our client information. We have a 35-year-old male, elite health rating from the state of Oregon. Death benefit. Now, I took this out of the hands of the software because we can do better if we don't just do what the insurance company tells us the software can do, okay? So I no longer have this checked, minimum death benefit, max cash value. I went to none so I could specify. Now, because I have to specify this, I go in and I tweak it and I figure out what is the best death benefit for the amount of money that we're going to try and put into this policy. And what I came up with is a base death benefit face amount of $60,000, and we're going to blend it with an additional $180,000 worth of term insurance. We still do the increasing death benefit, and we're still doing the $6,000 a year into the policy for our premium, okay? Everything else, exactly the same. Now let's look at our riders. Our riders are exactly the same. We still have all of our living benefit riders here. And our interest rate, 6%. Okay, same as the other ones. Now, what did we do for cash value? Check this out. Planned premium, $6,000. Now our surrender value in year one, $4,519. That is a huge difference from the zero, which was our first scenario, and just over $1,000 in our second scenario. Our death benefit, $245,000. Not bad. Now let's look at 30 years down the road. 30 years down the road, right here. We've got $6,000 that we paid into it every single year, $461,000 in accumulated cash value. And our death benefit, $701,215. So we've gone up an extra $65,000 from the original design by reducing our insurance costs in those first few years. We've gone up another $22,000 from our second design, which was what the insurance company said with their software. This will get you the minimum death benefit and the maximum cash value. Clearly, that was not the case. So this is what an optimized policy looks like. Let's look at the expense charges so we can see exactly why there's such a big difference with the design of the other policies and the design of this policy. Level death benefit. This is the expense charges on our very first policy with the level death benefit. See this? Level death benefit. We've got everything else. Male, 35, elite, non-tobacco, Oregon. Okay. Here is our expense charges. We've got premium expense charges. Every year you put into the policy, there's going to be a premium expense charge that comes out of that. It's kind of like their processing fee or their load fee, okay? Then we have cost of insurance. You will see this charge go up every single year, okay? Every single year the cost of insurance goes up because these policies use annual renewable term insurance. Now we've got cost of other benefits. We didn't include any in this policy, so this column is going to be 0. Policy fee, this is like your paperwork charge, okay? $72 a year. They charge you just to process all of the paperwork and mail you out the things you need mailed out or emailed, or if you're doing loans to and from the policy, all of that's included in the policy fee. Now we have expense charges. What are expense charges? These are, it basically makes up for what the agent makes. Okay. Your expense charges is the commission that gets paid to the agent as it slowly gets pulled out of the cash value in your policy. It may have to do with some other things, but that's what I associate it with, because we see that go down when we look at the other policies where we really reduce the commissions that the agents are going to be getting. Accumulated value charge, that just has to do with what your value is in your policy. That goes up as your policy goes up. Doesn't go up to a huge amount, but is just a little tiny bit of a charge that they put in there. And then we have our total expenses and deductions, which just adds up all of these charges. So in this policy, your level death benefit, that your typical fresh off the street life insurance agent might design for you if you told them you want to put $6,000 a year into a policy. These are the charges you'd get. $2,000 a year, going up, up, up until the commission is all paid out. But then we've still got $900, almost $1,000 a month, and that continues to grow. Okay. Let's look at as it even gets older. By policy year 30, a couple of other charges dropped off. Okay. But our insurance costs is continuing to climb up. Okay. $700 a year. Total expenses right around $1,000. Right around $1,000. Okay. Total expenses. Now it's not until we start getting into old age that we really see these insurance charges start to climb. $1,000, $2,000, $3,000, $4,000. Insurance charges really start to climb up as you get older. Okay. Okay, so that is option number 1. Now, here's our increasing death benefit option. Slightly optimized according to the insurance company's software. And let's see what we've got. We've got a premium expense charge. These are going to stay the same on all 3 policies. Cost of insurance, look at that. Cost of insurance starts out quite a bit less because we reduced that. We went to an increasing death benefit option. Still no other cost to our other benefits because our living benefits riders are all included in this policy. Policy fee, $72. That's the same as the other one. Hey, expense charge. That's quite a bit less than the last one was. Now it's only $694. This is because the agent, by switching to an increasing death benefit option, it cuts their commission down by quite a bit. Okay. And that's the expense charges here. Accumulated value charge. Okay. Again, this is just like the other one. The accumulated value actually is a little bit higher, a little bit more quickly, because this policy is growing in cash value quite a bit quicker. And you can see your total expenses now, instead of being around $2,000 to start out, they're just over $1,000, $1,175, and those increase until this expense charge drops off, and then it starts to slowly climb again. And we see our cost of insurance continues to go up. These are annual cost of insurance. Okay, so now let's look at the optimized policy. The optimized policy gives us premium expense charge. Oh, let's look at a quick look. Okay, see here we've got still male 35, elite non-tobacco, state of Oregon. Now our face amount is $60,000, additional death benefit $180,000. And premium expense charge, still the same, $360. Cost of insurance, looking good again. Policy fee, $72. That's all the same. Look at this expense charge though, $217 a year. That expense charge is as low as we can get it. That is the commission paid out to the life insurance agent. So In order for us to get your cash value the most, we take the lowest possible commission for the life insurance agent. Okay. Look at this. Total expenses and deductions, $700 for the first year, slowly going up, getting on down here to year 30, and we're still at $1,600 a year in year 30 for all of our expenses, even though our cash value is now up to $461,000. How did that compare with our first policy? Year 30, our expenses, total expenses, $1,126. So total expenses are slightly higher in our increasing death benefit scenario, but our cash value is only $395. That's because by reducing those costs at the beginning of the policy, you allow it to compound and grow a lot faster at the beginning. Now we've had 30 years of growth on that first year where we saved thousands of dollars in expenses. In the second year, we've had 29 years of compounding growth where we've saved $1,000 on our expenses. And that keeps happening year after year. So none of this stuff happens by magic. Now you guys can understand a little bit more of how the expenses of these policies relate to the cash value. And now you know how a properly designed policy looks. I hope this helps you out. I will be back in part 3, and I will show you what my personal IUL policies look like and how they performed over the last year, what type of growth that they had, and hopefully we'll get to any other questions that I might have missed in part 1 and part 2. So if you found value in today's video, please hit the like button down below, smash subscribe so you can follow along, and we will be back with more coming up. Now go maximize your cash flow.